Thank you very much. Good evening, everyone. I'd like to call the meeting to order and acknowledge that we're in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Innu, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 41st Nation in Treaty 3 territory. My name is Lynn Nesbitt, and I'm chairing today's panel. Joining me on the panel are Tracy Anderson and Valerie Werhun. Our assessor today is Jennifer Martins, and our administrative personnel is Zachary Mohan. We'll be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony. Anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I'll confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing item 2 and 6 through 8 on our docket today. Mr. Mohan, please affirm the assessor's and applicant's testimony.
Madam Chair. Okay, Madam Assessor, please state your full name.
Jennifer Martins.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And Mr. Applicant, please state your full name.
Rod Slaughter.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do. Thank you.
Thank you.
Thank you. And good evening again, everyone. We have 4 items on our docket today, so let's start right in at item number 2. This is file number 24-1438, 400 Assiniboine Avenue. Ms. Martins.
Thank you. This is for roll number 12092708000. That's 400 Assiniboine Avenue. For roll year 2025 with a reference date of April 1st, 2023, the assessed value is $4,820,000. This property is classed as 20 residential 2 with a liability status of taxable. It's an apartment building. There's 1 building on the property with 3 stories. It was built in 1929. It has 45 suites. And if we go to page 3, please. The suite mix shows that we have 1 bachelor, 28 1-bedroom, and 16 2-bedroom suites, which adds up to 45 units. The average monthly rent per unit is $1,024.27. That gives us a gross potential rent of $553,106, with a vacancy rate of 4.3%, an expense rate of 50.83%, gives us a net operating income of $260,268. We've applied a 5.4% capitalization rate, which gives us our estimated market value rounded to $4,820,000. On page 4, we have some rental comparables. These are in similar neighborhoods. They range from 3 to 5 stories. They range in age from 1961 to 1985. All the comparables have masonry bearing walls. They have range in unit numbers from 27 to 48. And the average monthly rent per unit goes from $1,037 to $1,236. We then have our capitalization evidence and our municipal act excerpts. And if you go to page 8, we have an overhead view of the property with a bit of a map to show where this is located on Assiniboine Avenue. And then we do have some pictures of the building itself and some from an interior unit. And on page 12, we start with our income and expense mailer. Showing that the rents are ranging from $681 to $1,000, I think that's 97. And then we have our income information that we get with. And that's my submission. Thank you.
Thank you, Ms. Mertens. Mr. Slaughter, questions for the assessor?
Thank you, Madam Chair, and thank you, Ms. Martins. I just do have a few questions. On page 3, you mentioned the average monthly rent per unit, $1,024.27. That's not the actual, is that correct? That's the market that's been applied?
That's what we, it's when we take our gross potential rent and divide it by the number of units.
Thank you. And on page 15, you include a copy of the owner's income and expense questionnaire from year end 22. And you'd agree that the actual rents, if we average those out, would be less than what is being applied as market. Is that correct?
Correct, yes.
Okay, thank you. And then on page 4, as backup, I guess, to the market rent applied, we have 4 comparisons. And the effective ages of those are all considerably newer than the subject. Is that correct?
Yes, they are.
Okay, thank you.
Mhm.
On page 3, you have your income summary, and a 5.4% capitalization rate has been applied by the city.
Yes, it has.
And on page 6, we have an excerpts, I guess, from the broker reports in Winnipeg. And you'd agree that of the 3, Collier, CBRE, and Cushman Wakefield, that for low rises of Class B category, the cap rates seem to range, depending on the broker, from 5% to 6%, correct?
Yes.
Okay. And the city has applied 5.4% to the subject property with an effective age of 1929.
Mhm.
This is a wood frame walk-up, correct? No elevator at all.
I believe that's right, yes.
And are you aware that this is also a heritage designation?
No, I wasn't aware of that.
Okay. Would that have any bearing on the capitalization rate?
I haven't looked into it enough. It does create issues with repairs being more expensive and potentially more difficult, but it also adds some people find that very appealing. So it would depend on the buyer.
That's all the questions. Thanks very much.
Thank you, Mr. Slaughter. Ms. Anderson, questions for the assessor?
I have no questions, thank you.
Thank you. Ms. Werhun?
No, Madam Chair, mine were just answered, thank you.
Okay, thank you very much. Okay, I don't think I have any other. Mr. Slaughter?
Thank you, Madam Chair. we have two sets of evidence. There's the direct regarding the subject property and then a capitalization rate study. Perhaps I'll go through that second.
Yes,
But for the subject property, if you could please turn to page 7 of our evidence. And Ms. Martins has gone through the description of the property, so I don't need to reiterate anything, but just to summarize, what we have is a 1929 wood frame walk-up without an elevator apartment. It has parking along one side only. There are approximately 9 to 10 stalls, which means that the ratio is less than 1 stall per 4 units, which is quite low. And it is a heritage status, which would have an effect on any potential repairs. There is no air conditioning, and the heat is steam. For our income approach on page 13, we have two main contentions. One is the market rent, and the second is the cap rate. The actual rents, and I mentioned this is included in the city's evidence as well on page 15. They're cited by the owner. $692 a month for the bachelor, $875 for the 1 bedroom, and $1136 for the 2 bedrooms. If we average that as we did on page 13, that works to $964 on average per unit. So we have a bit of a problem when we ignore the actual rents in place, but rather look to comparisons as a proxy for a market rent. When, of course, every property is a little bit different. You might have different effective ages in place. You might have a different mix between 1 and 2 bedrooms. A higher ratio of the 2 bedrooms over the total would inflate the rent overall compared to the subject. So we think, there should be a bit of caution when we look to comparisons only and not look to the actual performance of the subject property. So that's the very basic first contention, is the market rent applied, which isn't drastically different, but it's about $100, I think, per unit. Our expense ratio, bottom of page 13, I have a typo. I said 59.7 is 49.7% is the actual, and that's very close to the city. So we think the model is pretty bang on there. Very little difference. So the main difference then after the rent is the capitalization rate. So maybe I'll pause here, Madam Chair, and if I could refer to our second piece of evidence, the capitalization rate study.
sure.
Okay, and I'll make this quick. I think everybody on this panel and the assessor has heard us go through this many times. I'll just give you a chance to turn to that document.
Go ahead.
Okay, thank you. We have heard in evidence that the cap rates cited by the brokers as of the reference date for this type of property range from about 5% to 6%, depending on the broker. And we have that in evidence as well on page 6. One of the important starting points that we had when looking at capitalization rates is trying to understand all forces in the market. And one of the interesting things that happened by the reference date, on page 7, you'll see this, is that as a reaction to the artificially low interest rates during the pandemic, inflation started to take hold, and the Bank of Canada needed to raise their overnight rate significantly. You can see that on the bottom of page 7. They increased it about 400 basis points in the year 2022 leading up to 2023. And why is this important, you may ask? Well, if we were doing a review of how we calculated cap rates last cycle, notwithstanding other market forces such as supply and demand, if the cost of money goes up, capitalization rates typically will go up as well. But we're not doing that exercise. The reason I point this out is that this is an important factor that's influencing cap rates. Not the only factor. You can actually still have compression in capitalization rates if supply demand is very favorable. But it is a factor which would be pushing an upward effect on cap rates. And the second reason I mention this is that if the overnight rate, which determines then the the bond rate for 10 years, if that is at 4.5%, 450 basis points, which is 400 basis points more than it was in April 21. We have to consider that when we look at capitalization rates, a flag is raised if we see anything that is even 5% or under. And the reason is that an investor, when looking at a asset, such as a real estate asset, will expect to have a greater return on their investment than they would for a risk-free bond. That's just basic 101 real estate finance. And the reason is it's not as liquid. Like with a bond, you can sell at the end of the term. It typically has an return as well, interest return. But you have what's called a spread between risk-free investments and then real estate investments. And they can range from 100 basis points to 300 basis points. So if the risk-free investment is at 4.5%, we really have to question when we see a capitalization rate calculated that's under even 5%. It can happen, but typically when it happens is because the investor recognizes I have a heck of a lot of upward potential here. So I'm not really buying the income at a 4% or 4.5% cap rate. I'm buying the potential for very quick escalation to my income. So with that background, we then look on page 12 to the few cap rates that we could analyze. And this gets very difficult because when we look at a universe of sales leading up to the reference date, we then have to look at factors such as, is it arm's length? Was it untypically motivated, for example, by renovations that occurred and all those sorts of factors? And when our team was done, we had basically 5 cap rates that we felt relatively comfortable with. The first is 345 Talbot. This is built in 1970, and the cap rate that we calculate based on the advertised income is 6.48%. It had an asking price of $2.75 million, and at the time they were asking a 5.2% cap rate, but of course that wasn't what happened in the market. It sold at $2.195 million. And if you simply take the income from their listing and work that through with the actual sale price, you would also come up with 6.5%. The second is 677 Maryland. We calculate that at a 7.11% capitalization rate. This is an inferior property. And the third is a superior property, a newer property on Maryland, built in 2017, and we calculate a 5.44% cap rate. Fourth, we have 150 Hendon, which we calculate, it's built in 1972, and we calculate that at 5.42%. And lastly is 2390 McPhillips, a newer property built in 2015. The city and Altus share some of these cap rates, but we have differences in how we reach the conclusions. I'm going to state that what Altus has done is pretty aggressive when we calculate a 5.59% cap rate. And I think, in hindsight, we would probably be comfortable with something that lies between what the city says, which we think is overly optimistic, and what we have done, which is maybe on the aggressive side. And that is looking at market rents rather than the actual rents at the time of sale, with the understanding that the actual rents were below market. But the first 4, I think, are better comparisons. And what they basically show is that the brokers' studies that mentioned a floor of 5% up to about 6% are corroborated by what we see. Inferior properties may go above that, like the one at 677 Maryland, but generally we are in somewhere in that range of mid-5s to 6% for a older wood frame walk-up property with limited parking. It makes sense. So with that, if I could ask the panel, please, to return to the main evidence on page 14. We start with a base cap rate based on effective age. And you can see that on page 14, pre-1946, we consider to be 6.1% to 6.6%. And then we would make adjustments. Now, one of the adjustments that I personally like to make is that if I think the effective age is questionable, if I think, there's been no adjustment from the original age with the effective age, and we look at the R&M and we see that there has been some work put in, not necessarily capital, but there has been work put in, I might make an adjustment for condition. And I've done that in this case by 25 basis points. So starting with the minimum base of 6.1%, we adjust that downwards to recognize that the effective age may be off. It may be too low. And the second adjustment that we make, although this one is questionable even, from when I look at this with hindsight, is location. Now, when I was preparing the evidence for this, I was typically looking at properties in the River Osborne area, and we would make an adjustment for those areas as being superior. And we make an adjustment of 10 basis points. I'm not sure in hindsight that this location would warrant the same adjustment. Downtown is suffering. It has vacancy issues in some of the multi-res. And I think that may have been a little optimistic, but in any event, I did apply it. And the concluding cap rate, which again is corroborated by both our evidence for the cap rate study and certainly by the broker reports when we consider the age and the parking and the wood frame and the lack of elevator, et cetera, 5.75%. So on page 16, we have the conclusion of our valuation. It's basically applying the actual rental income as of 2022. We add parking and laundry. We deduct the market vacancy of 4.3%. The expense ratio is almost identical to the city's. Our NOI then is just a little less than the city at 249,486, about 10,000 less than the city. So the real difference isn't really in the NOI. It's really in the cap rate. And the cap rate that we apply is 5.75%, which brings us to an overall value of $4,387,000. And that concludes our presentation. Thank you.
Thank you very much, Mr. Slaughter. Ms. Martins, do you have questions for Mr. Slaughter? You are muted.
Yes, I do. I'm just looking for it in the cap rate evidence. On page 17 of your cap rate evidence,
Yes.
it looks as though there are there is very little information where we usually see a lot of information in your workups like this. How do you come up with all of this, the stabilized values if there's no information in that you've shown to stabilize?
Yeah, good question. Thank you, Ms. Martins. And oftentimes we won't have all the information on property. So again, we start with a universe of sales. We go through those to determine which we are able to look at. And then we do the best we can to try and piece together what we think the income is. If I can ask you to turn to page 57. What we did in this case is we took a look at what was being advertised for the property at the time of sale. And you can see that the offering price was 2.75 million, which implied a cap rate of 5.2%. If we work that cap rate back on that asking price, that would be an income of 143,000. In fact, the property sold for much less. It sold for 2.195. Well, now we know what the vendor was advertising as the income, and we can apply that income to the actual sale price, and we have 6.5%. But on page 17 that you asked me about, actually what our team had done is go through a market analysis. They tried to look at what's the reasonable market rent based on CMHC, the market vacancy, add for parking. They applied a 40% expense ratio, everything that seemed reasonable. Now, not the ideal stabilized approach we typically take, but what we have in the end is an NOI that is quite close to what was actually reported by the vendor. So in the end, we say to ourselves, does that pass the sniff test of being an accurate picture of what the rate of return that the purchaser was buying? And we think it does.
Okay. So basically you created your own model to come up with an estimate of the cap rate?
Yes, but the main thing is then we tested that to what was actually being advertised as the income.
Okay. And I guess the same went with number one. Sorry, I'm just looking for the page.
I'm sorry, Ms. Martins, you you said page 17. I was talking about 345 Talbot. Did we just get mixed up on, did I mix myself up on properties there?
Well, you know what? It's really the same question for Talbot. So it's probably do you use the same method for the other properties?
Exactly. Yeah, we'll have in evidence how we arrived. If we don't have the 3 years of income, how we arrive at that number. And oftentimes it will be using the listing to make sure that our assumptions are correct. So sorry, I led you to the evidence for Talbot, but it's the same idea as property on page 17.
We took a different route, but we got to the same place. Okay, that's all my questions. Thank you very much.
Thank you very much. Ms. Werhun, questions?
I do not, thank you, Madam Chair.
Thank you. Ms. Anderson?
I have a couple of questions. Your page 14. That heritage status designation, you've listed it here as inherent. So
Yes.
is it actually heritage status or not? We're just
It is.
thinking it is because of the age.
No. Well, I researched this and it definitely is heritage. I wasn't able to ascertain if it was previously they used to have grades 1, 2, 3, and they didn't have that on the listing or the Manitoba Historical Society page. So I'm not sure what grade it would have been, but it definitely is a heritage status building.
Okay.
And
And
so,
then,
yeah, sorry,
sorry.
to answer your question though, we often will make an adjustment for that, but because I'm starting with a base age of 1929, I did adjust for condition, of course, but I simply say that, it's a factor we need to consider, but I'm not making a quantitative adjustment for it.
I see. Okay. And so let's speak about your quantitative adjustments for condition. How did you come up with 25 basis points? Like, what is there a scale? Is there a page I'm missing that I should be looking at that says, because it's 1925, 10, and because it's got boiler heat, 10 more, and no air conditioning, 5 more. So could you explain how that works for me, please?
Sure. Yeah, and it is very qualitative, not quantitative. I would love if we have the data or had the data to be able to quantify it better. But what I've done is, as I'm looking at a property, and there is no reason for me to believe that it is in the condition that would not warrant a different effective age than original, as is the case here. The original age is 29, the effective age is 29. And we don't often see that. Oftentimes we'll see an adjustment to an effective age of 1950 or something like that. So I made a subjective decision that I didn't believe 1929 was an appropriate effective age. And on the chart that we have on page 14, we have the divisions of different ages. So basically what I did is kicked up the property in its effective age into the mid-century categories, which put you around 5.75 or up. That's basically what I was trying to do when I said 25 basis points. Completely qualitative, completely subjective, but I think a fair adjustment.
Okay. That's it. Thank you very much for your answers, and thank you, Madam Chair.
Thank you, Ms. Anderson, and thank you for that question too, because I was going to ask it also. So I don't have any additional questions. Ms. Martin, would you like to make a summary? You're muted.
Sorry, Madam Chair.
Oh,
I
yes.
actually, sorry, before we get to summary, I did have rebuttal to the
Oh.
city's capitalization rates as well.
I'm sorry, Mr. Slaughter, and
I
you do
also
too,
have
Ms.
rebuttal.
Martins? Okay.
Yes.
Okay, I apologize for that. Then Mr. Slaughter, your rebuttal.
Thank
Just
you.
give us a minute to make sure it's distributed to us, okay?
Certainly.
I'm not seeing it. I'm sorry, Madam Chair, excuse me. I'm not
no,
seeing it in my.
Mr. Mohan has to get it to us. Mr. Mohan, can you let us know when it's there, please?
Of course. Okay, both rebuttals have been uploaded. They should be under like number 7, orders detail realty for both of them.
Okay.
As for, I just sent the email to the assessor. And I'll send one to Mr. Slaughter as well for the EMT one.
Okay. And I apologize, Mr. Slaughter and Ms. Martins,
No
for
problem.
not asking about that. Ms. Martins, can you let me know when you have the rebuttal, and Mr. Slaughter also?
I have it.
Thank you.
I don't have it yet. But I can go ahead, Madam Chair, because if
Okay.
I'm presenting first, I'm sure it'll show up soon.
Yep. Okay,
Okay, so we've prepared a small rebuttal on the city's cap rates. And again, we talked about what the brokers are stating, and that was part of the evidence, but then the city had a subset of capitalization rates also in their evidence. And we've taken a look through those. So on page 2, we have a summary of what the city had shown. And basically, I break the comments into 3 categories. There are those where the cap rate, we have no information on the sale, but we just look at the property and we think, how could it be that low? Something seems strange. So the very first one is one of those, 727 Sargent. This isn't an ideal area. It's a 1955. I imagine it's a walk-up, 2-story, and the quoted capitalization rate is 3.46%. Now, recall what I was saying when I was talking about our cap rate. A big flag is raised when you see a cap rate for a real estate asset that is under what a risk-free investment would be. Again, it can happen, but there's got to be a story. And we don't know what's happening here. We don't know what the calculation is. The city hasn't exposed how they determine the cap rates, unlike how we did in our cap rate study. So we're unable to say, well, wait a minute, that just doesn't make sense. That rent's far too low or that expense is far too high. So all I'll leave the panel with is that 3.46% seems rather optimistic at this reference date. The second comparison is 459 Sargent. The city calculates 4.8%. And I'm going to try and keep this brief, Madam Chair, but on page 5, we do a analysis of that property as well. And we come up with a very different cap rate of 5.79%. And how do we do that? Well, again, we look at we have the stabilized income and we show how we come to the capitalization rate. But the NOI, the total income that we're applying, the total top revenue is just around 100,000. And if you turn to the next page, page 6, we have the MLS summary of the sale. And you'll see near the bottom left of that summary, it has gross income, 101,000. That's the income on the top line, the revenue. And then they have net income of 74,000. Well, we take that with a grain of salt because we don't know what adjustments have been made. But that's a lot higher than what the city's used. I mean, we're applying 57,000 as the income, and we come to a 5.79% cap rate. So again, something seems odd, in our opinion, in the calculation of that cap rate. And the third category is ones where we actually have it in our evidence as well. So that's like 150 Hendon. And again, we calculate that much different than the city. We calculate it in the mid-5s, and they have it at 4.01%. Similarly, further down the city's list of comparisons is 2390 McPhillips. You'll remember that I talked about that sale. I think we're pushing it a little bit at 5.6%, but certainly the 4.71% doesn't seem appropriate. This is a new property, though. It's 2015, so it's not really germane to our discussion for the subject. And the next one is 700 St. Mary. We had, I'm sorry, actually, we don't have that one in our evidence, but that again is one that we just find considerably low at 3.6%. Otherwise, the cap rates, besides those ones we have concerns with, for the most part, are kind of corroborating what we saw from the brokers and our study, which is in the 5s to 6. I think a very interesting comparison is the very last one, which is at 555 Corden. And that's a walk-up. It is a mid-century walk-up, though, 1955, and that has a 5.74% cap rate. So I think once we look at the ones that we kind of go, well, that seems a little low, and then when we dig into it, we find reasons why we believe it is low in the calculations, and then we look at the ones that are left, and we don't feel that we'd be far off in conclusions. So we have a lot of supporting information, Madam Chair, and I think we've gone through this with the panel many times, so I'm going to pause on that. I'm going to leave with one quote, though, and this is on page 32. And this comes from a Manitoba Municipal Board, where the argument before the board was, listen, when you're looking at a sample of sales and you're determining cap rates, and you realize that some of these sales were for properties where they underwent significant improvement, or they went to the RTB and they asked for a rent increase, but that's not being considered. And sorry, that happened before the sale, but that's not being considered in the capitalization rate calculation. In other words, somebody is buying a definite 100% guaranteed income that's greater than the income being used in the capitalization rate calculation. And on page 32, in highlight, the agent, Mr. DuPont, he further stated that cap rates determined from existing income stream of any property purchased with an intention to renovate or convert to condominiums should not be considered. These purchasers do not have the typical motivations, and a cap rate calculation is likely lower as it does not consider the post-renovation income model for a return on total investment. And if you go ahead to page 34, the board states, with the 4 remaining comparables, sufficient concerns were raised by the appellant on 3 of them regarding the purchaser's intention to significantly renovate or alter the structures. The appellant produced evidence from the purchasers, which makes the board question the use of the purchase price and income information. The board does not accept that any intention to renovate should disqualify a property sale. A renovation must be of significant financial investment on the part of a property owner, one that will cause future rents to substantially increase, and should usually involve modification to a building envelope or realignment of structured walls. So they're saying that, if you're doing a lot of work to that property, it might not be the best indicator of a cap rate because you're not really buying the income in place. That's our concern, Madam Chair, with Hendon, the third comparison, which the city came at a 4.01% cap rate. Starting on page 7 and moving through the following pages, we have the information from the RTB where the owner went just before the sale and said, we've done this work and our expenses are X. We'd like to increase the rents. And they were granted that. And that was granted at the same time as the sale. And then the income that we're using happens to be exactly the income at the end of that fiscal year. So again, we're not sure how the city calculated it, but we're trying to say, look, if you look at what actually happened with this property right before the sale, here's the cap rate. It's higher. And there's one other example like that, Madam Chair, in our evidence for Arden, 32 Arden. On page 24, you will find a letter from the property management where they state the owner purchased 700 St. Mary. Oh, sorry. This is 700 St. Mary's was the one that was a 3.8 cap rate. On page 24, the manager states the owner purchased that property with the intention of renovating the building as it was in rough shape, and the previous owner had done nothing for repair in quite a while. So we're kind of cautious about that one too. It might explain why the cap rate appears so low, because the income was much lower than what the owner knew that they could attain once they put some work into the property. I'll pause there, Madam Chair. Those are our concerns when we see those low cap rates, and I think we need to take those with a grain of salt. And when we look at the rest, I think we're not far apart in our conclusions. Thank you.
Thank you, Mr. Slaughter. Ms. Martins, questions for Mr. Slaughter?
No, thank you.
Thank you. Ms. Werhunt, questions?
I do not, Madam Chair. Thank you.
Ms. Anderson?
I have no questions. Thank you.
Thank you. Nor do I. Ms. Martins? Your rebuttal, please.
Just looking at our rebuttal quick. There is on the front page, I included 738 St. Mary's Road, but that actually isn't in the applicant's evidence. So if we can ignore that, please. Basically, and you've seen our rebuttal, just discussing our difference of opinion of how we calculate income for the purposes of finding a capitalization rate. And where we have that, sorry, if you look on page 2, there's 1 year that's not stabilized income. And if you look on page 4, we've discussed that we have differences of opinion on that one, and that is, again, we don't have enough income and information, income and expense information to find stabilized. We've heard the explanation that they create their own model for that, and we don't disagree that that's an appropriate way to find a capitalization rate. And the same thing for number 6, that's St. Mary's. On page 9, you see for 100 Maryland, and there was no actual data used for the calculation of the cap rate. It was all a model that was created. And we just disagree with the methodology that is used by sorry, it's by Ryan ULC in this, for these. That's it.
Thank you, Ms. Martins. Mr. Slaughter, questions?
Questions? I'll just reserve for summary. Thank you.
Thank you very much. Ms. Anderson?
I have no questions, thank you.
Thank you. Ms. Werhan?
No questions, thank you.
Thank you. Okay, Ms. Martins, summary statement.
No, thank you.
Thank you. Mr. Slaughter?
I think there's two main points, Madam Chair. One is that we don't feel that looking at other properties to determine market rent is ideal in this case. We have the actual income for the subject property, and we've used that. And secondly, for the capitalization rate, fair points by Ms. Martins. We'd love to have all the data to be able to do a proper 3-year stabilized, but what we try and do for the panel's reference is provide the rationale of how we determine the cap rates. And we feel it's sound. I mean, we're looking at what was being advertised in the cases where we don't have stabilized income. It's coming right from the vendor's advertisement. This is what we have as income. So we feel that they're appropriately calculated based on the information that we could bring forward. And in the end, I don't think a 5.4% cap rate is realistic for this type of property. I think 5.75 is more supported by the evidence. And that's all. Thank you.
Thank you very much. Okay, that will conclude item number 2. Before we go on, Mr. Slaughter, your cap rate study, it will be applied to all the other items on the agenda as well?
That's correct,
Okay.
Madam Chair. I don't need to go through that again.
Okay, and Ms. Martins and Mr. Slaughter, your rebuttal evidence, will that be applying to all the items on the agenda also?
Yes, please.
Yes, please.
Okay. That's good to know. So we don't need to go through it again unless you believe that something needs to be raised that you didn't raise. Put up your hand, let me know. Otherwise, I won't. I'll just note that it will apply. Okay, that will, moving on then. Item number 6, this is file number 24-2989, 388 Kennedy. Ms. Martins.
This is 13053089100 Kennedy Street. We have the assessed value at $5,917,000. This is classification of 20, and the liability status is G, grantable. This is an apartment building. It is a single building with 8 stories, built in 1983 with 54 suites. If we go again to page 3, please, we have the income. We have 2 1-bedroom units, 32 bedroom, and 22 3-bedroom, giving us 54 total units. We have the average monthly rent per unit at $1,060.42. This gives us a gross potential rent of $687,152. We've applied a 4.3% vacancy rate and a 53.66% expense rate, giving us our net operating income of $304,734. We've applied a 5.15% capitalization rate, giving us the estimated market value rounded at $5,917,000. On page 4, we have some rental comparables. These are 3 to 6 stories. They were built in 1957 through to 1982. And the average monthly rent per unit ranges from $1,089 per month to $1,399. On page 5 and 6, we have our CMHC average apartment rent versus modeled rent. And it shows that our weighted average for the potential rent for the market for CMHC is, roughly $1,440.16. And it shows that ours is 73.63% of that. We have our cap rate, and we do have some pictures starting on page 11. The map showing where this property is located. And a picture, a Google Street View picture, two Google Street View pictures, sorry. And then we do have a permit showing that there was some work done. It was a while ago, it was in 2007. Okay, and that is everything. Thank you.
Thank you, Ms. Martins. Mr. Slaughter, questions?
Madam Chair, thank you, Ms. Martins. To confirm, this is a social housing property, is that correct?
Yes, it is.
Okay, so the rents cited, and I think you explained this, but they're not, of course, actuals. The actuals would be much lower rent geared to income, correct?
Yes.
Okay. And the location that you show on the map, it's basically very close to Central Park, correct?
Yes.
Would you agree that that's, how would I put this? It's,
Troubled neighborhood?
yes. Yeah. Okay.
Yes.
Thanks. So it appears that the cap rate is applied based on the city's evidence, but there's been no adjustment that I can tell for the fact that this is social housing or for location. Is that correct?
We are mandated to treat social housing with market parameters.
Okay. That's all the questions. Thank you.
Thank you, Ms. Martins. Ms. Anderson, questions for the assessor?
I have no questions, thank you.
Thank you. Ms. Werhan?
Yeah, just one. On your comparables, the number 4, I was just curious why you used the 1957 effective year built building, much smaller than your subject property, much older.
To be honest, it's difficult to find rents that look very comparable to this. So we're looking at buildings that may perhaps be something that is substandard to what you're seeing, because I'm not sure if this one that we used as a comparable is social. No, this one wouldn't be social housing, because a lot of the properties that are comparable, if they are social housing, we don't get rents, and we in order to have reliable rental information, sometimes for something like this, we had to go to a building that was could be considered inferior in order to find a rent that actually is in alignment with what the model put on this property.
Okay, thank you. No further questions, Madam Chair.
Thank you. And I have a question just following up on one of your statements, Ms. Martin. You said you were mandated to assess at.
We do
Sorry.
them at market. We don't say this, we're supposed to find market value, and we're supposed to put value for the purpose of taxation at market value. Whether this with the grantable properties, they don't want to be treated as though they're we treat them at market value. So we are mandated to value them at market. We're not told to value. That's why we use comparables for the rents. We don't use actuals. We use what we find for market, because it's for the purpose of taxation, and we're supposed to have market values and treat it as it would any other building, regardless of what the purpose is.
I appreciate what you're saying. I truly do, and I understand the mass market appraisal approach you're using. When you have a property, though, that might be the condition might not be the same, and all those things, despite its age, despite everything else. Wouldn't you look at that and make site-specific adjustments, recognizing that, and that is the market?
Well, obviously, but the thing is, we aren't able to go and inspect. It's the amount of properties that we have. We can't do site-specific for all of the properties, because
No, and I appreciate that.
we have
Yeah.
a 2-year turnaround.
Yeah.
So we can't do site specific on everything. So when we are doing these, there's a lot of them that are treated as below average or poor condition. And that is reflected as part of the market as well. Like when we're
Okay.
looking at the parameters that we're using, there's a significant number of these that are considered below average condition. And that would be reflected in the fact that these other buildings have higher rent, and we had to go to one, as was mentioned, from 1957, that's much smaller, in order to find comparable rents,
Okay,
because we are treating them
okay,
as it's what is market for the condition, the neighborhood, and all of those things.
okay.
But still,
So your adjustments then,
Mhm.
maybe that's the wrong word to use, but it's reflected in your rents. It might be reflected in your expense ratio,
Yeah,
not,
exactly.
but not in your cap so much.
No, it is reflected in the
It
cap.
is.
But the thing is that we have very different opinions on methodology for cap rate, and so, and the purpose of what we're doing, the department is mandated to do computer assisted mass appraisal, and we apply it across the board, and we want equitability for the fair distribution of taxes.
Right. Okay.
So
Okay.
there's not one specific, I don't have a specific customer that I answer to that wants their taxes lowered. So my mandate is to treat all of the properties equitably so that the distribution of taxes is fair.
Okay. Thank you, Ms. Martins. Ms. Anderson, did I forget you? Your questions? Do you have questions? Can't tell if she's frozen. Tracy, do you have questions?
No, ma'am, no
Okay,
questions.
thank you. Okay, Mr. Slaughter, then your presentation.
Thank you, Madam Chair. We have evidence in place and we have pictures of the property, but I'm really going to kind of cut to the main difference in the opinion of the assessment department and ourselves. And that is that we don't feel that one size fits all for these type of properties. That the legislation, as we're all aware, is quite clear that we assess based on value as of an applicable reference date. And it's been stated by the municipal boards and the courts that so long as we assess on value, then equity is achieved. Fairness is achieved. Equity is the wrong word, but fairness is achieved. Equity is not in play in the legislation as far as we can interpret. So if we have a different type of asset, we don't think it's appropriate to treat it in the same way that we would for other assets when it comes to especially capitalization rate. Now, social housing is tricky to value because we obviously can't use we could, but we don't use the actual income in place. It's rent geared to income. It's significantly less than what would typically be achieved in the market. So the approach is to use something based on market, and typically it's going to be 70 to 80% of CMHC. That's kind of the general rule. And then we use a typical expense ratio, while the actual expenses in these type of properties are often quite high. These properties are designed not to the market, but rather to the specific purpose that the mandate that they had, which is to house as many people as possible. And unfortunately, there's only so much that the government can do in these cases. And so typically, we don't have the highest degree of finishing. We don't have air conditioning, for example, in these units. They're going to be fairly basic because they just need to house people. Repair and maintenance is usually quite rare. Every once in a while, there'll be a large investment into the property when it requires, but this isn't, freshening up the suites necessarily to some higher degree. This is, to fix problems with the structural envelope or the balconies or anything else with the property. And that only comes along when the government has the funds to do so. In 2017, it was stated that Manitoba housing as a whole was about $500 million. Let's find the quote here. They were about $500 million in deferred maintenance required. And the government at the time dedicated $31.2 million towards repairs and upgrades. It's not sufficient. And this is an important factor. I mean, and we see this when a Manitoba housing property does go to market, it's not going to command the sort of prices that market housing would. On page 14, we go through some of the quotes from municipal board orders and appraisal texts and textbooks on the valuation of social housing. And this is not a new concept. Municipal Board Order A02-330, back from 2002, quotes an excerpt from the Appraisal Journal in January 1996, which stated, low investment grade apartments warrant a higher yield and overall rate than conventional apartment properties, period. The applicable rates tend to rise with the presence of each of the four characteristics: low cost or low quality construction, advanced age, declining or blighted neighborhoods, and low income tenancy. Now, to be fair, this is a concrete construction. I wouldn't necessarily say it's low quality in the actual skeleton, but it's certainly low quality in the finishing. It is not of advancing age, but it is in a declining or blighted neighborhood. I say that cautiously, but it's not an ideal neighborhood when you take a look at the crime stats and other such figures. And it is a low income tenancy. One justification for the high applicable rates is the added risk caused by several factors. These include a high operating expense ratio and a low net operating or net income stream, with increased variability of the income stream because changes in gross income or expenses have a greater relative impact on net income when the rent levels are low. So what they're saying is, well, we can ignore the fact that the actual NOI is far less than what we're applying as market, but you can't ignore the fact that this is a different type of property with a different type of finishing in a different area with a different construction. Remember, the subject property is predominantly 2 and 3 bedrooms because a lot of the tenants of Manitoba housing will require larger areas. That's not typically the market standard. The market standard is usually a mix of 1 and 2. So even in its design, it's not necessarily built to market standards. A second board order, a year later, Municipal Board Order A03073 states that capitalization rate premium for social housing is still warranted even when other valuation parameters have been adjusted, like we have for market rent and expenses. Let me just get to the point here. The agent pointed out that the subject represents a relatively high-risk investment. As a result, the agent said he believed that a capitalization rate of 11%, at this time they were using 9.5, would be appropriate. The board is of the opinion that a capitalization rate of 9.5, which was the base, does not adequately reflect the fact that the subject is more of a high-risk investment than the assessor's comparables. As a result, the board is of the view that a capitalization rate of 11% should be applied. They're applying a premium. So now we see a consistency in that rationale. A gentleman named Richard Polton wrote a textbook called Valuation and Market Studies for Affordable Housing. And he again states, developing a market-derived capitalization rate for an income-restricted property begins with an analysis of the available rates for similar unrestricted properties. Then these rates are adjusted based on the risk factors that an investor would consider in developing a capitalization rate based on market factors and associated risks. So we have the factors with the subject property that would warrant adjustment in our opinion. It's not designed for market A. B, it's in an area that has some difficulties. And C, it has a low income tenancy, which means that there isn't the money typically reserved for repair and maintenance. It has a high expense ratio. Page 16, we go further into that item of low income tenancy and how it affects the physical nature of the property. And we talk about one example of a Manitoba housing property selling in the downtown. It was 185 Smith in 2018. And it sold for considerably less than a typical market apartment. It required significant improvements to the property because of the deferred maintenance. I think the end price was about $50,000 per unit that was paid. So on page 17, how we approach capitalization rates for social housing is basically following what the boards and the textbooks tell us. Start with your base rate and then make adjustments. And we typically make adjustments of 25 basis points for any of those 4 categories that I mentioned. There's a recent municipal board order for 355 Sutton that follows exactly the same logic. In that case, it was a well-located and well-maintained property, but it did have the low-income tenancy and it did have functional obsolescence. So they adjusted the cap rate by 50 basis points. In our case, based on the age, we would start with a base of 5.5%. Again, that is corroborated by the evidence we talked about in our cap rate study and the broker reports. But then we adjust for location and the low income tenancy, and that would be a 50 basis point adjustment upwards. This is consistent with almost every single municipal board on the subject. Again, you can have higher premiums if it's so warranted. I haven't made further adjustments. So we go from 5.5 to 6%. And on page 19, you will see the actual expenses, which are far higher than what's being applied, but we're applying the market rent is applied by the city and the market expenses. So we agree with the NOI, but then we need to make the adjustment for the cap rate. And we feel that 5.15% is not appropriate for this property. We feel 6% is more appropriate. Applying 6% brings us to a final value of $5,079,000. And that concludes our presentation. Thank you.
Thank you, Mr. Slaughter. Ms. Martins, questions?
Oh, you're on.
No, thank you.
No questions? Okay, thank you. Ms. Verhun, questions?
No, Madam Chair, thank you.
Thank you. Ms. Anderson? I'm sorry, you skipped there. Your video skipped. No questions?
Are you asking me again?
Yes.
I'm
Your
sorry, you guys
video-
were all,
your-
you were all frozen for a second, so I was just madly scrambling to try and see if
No.
it was me or what was going on, so I apologize for that.
That's
I
okay.
do actually have two questions. So on your page 13, it's not much of a question, it's kind of I think there's an error. Your vacancy allowance, it says you're agreeing with the vacancy of 3.2, and then on your workup sheet, it's 4.3, the same as the cities. So I just wanted to point that out.
Yeah,
And the
that's a
other
typo.
thing, okay, the other thing I wanted to point out was your page 17. It says no amenities, and can you just define that for me? Like, what amenities would you look for in order to rise up this inequality?
Sure. So again, the premise of the argument, I think, between our study and the city is that this is no different than the market. You know, take this property and apply market capitalization rates. And there's a number of reasons. We've heard some from various sources of the things we look for that we make adjustments for. Amenities is something that we do look at in capitalization rates. And again, this isn't built for market. This is built for the specific mandate of housing as many people as possible. So it doesn't have any of the additional features that you might have in a typical market apartment, including any space for landlord. You know, it's very bare bones. So when we say amenities, we mean, well,
Laundry?
Well, it has laundry on the main floor only. But
Shared laundry.
you know,
Shared
other
laundry.
things that you might find in better apartments. It has nothing. It's very bare bones.
Okay. And that's it. Thank you, Madam Chair.
Thank you. I also have a question on your page 17, Mr. Slaughter. When you talk, there's a row there called supply and demand. How does that relate to this particular type of property?
Yeah, that's a good question, Madam Chair. So it really doesn't anymore. When we were first working on our studies, this is going back a couple of years now based on the reference date, and we were finding that supply was outpacing demand, but that was because of the pandemic. I mean, demand has picked up since then. But what we do find is that the older stock, there's always a flight to quality. So as you have new product come onto market, it's usually the older product that will suffer first, or inferior product. So that's simply what we mean by it. We're not making any adjustment. We're just making a comment that typically when you have supply increasing, there is a flight to quality.
Okay. But in relation to this particular property, which is social housing, this wouldn't have relevance, would it?
I didn't make
No.
any adjustment for that factor.
Okay. And so the rows where you did make adjustments, your 0.5 premium, is that
Well, it's not
because
even
it's social
shown.
housing, or is that because of which?
It's
don't-
two. So generally the four factors that are cited, especially
Yeah.
by Fulton, are inferior construction. Now, again, this is bare bones finishing, but it's not inferior construction. So we haven't made an adjustment for that. The second is location. That deserves an adjustment. The third is it a low-income tenancy property, which has low income, high expenses, and likely not the repair and maintenance you typically find, and therefore likely concerns that the investor would have to consider. It has that. All social housing does. That's another 25 basis points. And the fourth is functional obsolescence. Now, if we find an example of a property, Sutton is a good example. It had odd layout in the units, and if it went for as a market apartment, it would be a concern. We made an adjustment, and the board agreed in that case. This doesn't have that. This is pretty standard. The only concern I would suggest is that it's geared to a higher number of rooms, which the typical market wouldn't necessarily be, but we're not making an adjustment for functional obsolescence. So of the four items, Madam Chair, just to summarize, it's location and low-income tenancy.
Okay, thank you very much for that.
Thank you.
Okay, I have no additional questions. Summation, Ms. Martins?
No, thank you.
Thank you. Mr. Slaughter?
Thank you.
Okay, thank you. All right, that will conclude item number 6, sorry. Moving on to item number 7. This is file number 24-2991, 400 Kennedy Street. Ms. Martins.
This is roll number 13053082100, 400 Kennedy Street. The assessed value is 4,605,000. The classification is 20, and the liability is grantable. That there is one building with 8 stories constructed in 1983. There are 42 suites. On page 3, we have our income value summary. There are 28 2-bedroom and 14 3-bedroom, giving us a total of 42 units, with the average monthly rent per unit at $1,047.04. We have a gross potential rent at $527,708, a vacancy rate at 4.3%, an expense rate at 53.04%, giving us a net operating income of $237,156. To that, we have applied a 5.15% capitalization rate, giving us an estimated market value rounded at $4,605,000. We have some rental comparables on page 4. These are up to 9 stories. They range from 44 to 72 units. And the rent averages $1,069 to $1,414 per month. We do have our CMHC average rents. And if you look on page 6, it shows that our percentage of market rents is at 76.27%. The average market rent, if you look at CMHC averages, is $1,372.78. On page 11, we have our overhead view and a street view and another overhead view, just showing location and the style of building. And what's the year on this one? It shows that we do have a permit from 2022 where the declared construction value was $65,000. And this was doing interior alterations, including repair of walls, doors, frames, flooring, insulation, ceilings, etc. Okay, that's everything. Thank you.
Thank you, Ms. Martins. Mr. Slaughter, questions?
Thank you.
Thank you. Ms. Anderson?
I have no questions. Thank you.
Ms. Verhan?
None, thank you.
Thank you. And nor do I. So thank you, Ms. Martins. Mr. Slaughter?
Thank you, Madam Chair. I'll keep this very short. Page 7 are photographs of the property. This is basically the sister property to 388 Kennedy. In fact, on the income and expenses that you'll find in evidence, you'll note that it's blended. They just treat it as one property over two buildings. So it's the exact same argument. We're accepting the city's rent, we're accepting the expense ratio, but we don't feel that a 5.15% cap rate is applicable or warranted, and we're applying 6%. Same logic. And so our
Okay.
value, simply applying the different cap rate, comes to 3,953,000. And that concludes our presentation.
Thank you, Mr. Slaughter. Ms. Martins, questions?
No, thank you.
Ms. Werhan, questions?
No, thank you.
And Ms. Anderson?
No questions, thank you.
And nor do I. Summation, Ms. Martins?
No, thank you.
Mr. Slaughter?
You.
Okay, that will conclude item number 7. Moving on to our final item, number 8, file number 24-2994. This is 421 Kennedy Street. Ms. Martins?
This is rule number 13053044000. The assessed value is 3,089,000. The classification is 20 and the liability is grantable. This again is one building, 7 stories, was built in 1978 and has 31 suites. On page 3, they have it broken down to 18 2-bedroom suites and 13 3-bedroom suites, giving us our 31. The average monthly rent per unit on this one is $966.72. That gives us a gross potential rent of $359,620 with a vacancy rate of 4.3% and an expense rate at 55.57%. We have applied a capitalization rate of 4.95%, giving us our estimated market value at $3,089,000. Again, we have a few comparables on page 4 with the rent ranging from $1,030 per month to $1,568. We do have the MHRC averages, and on page 6 shows that the average market rent, if we use the combined averages, is $1,397.41. So for this property, we are at 69.18% of that. Page 11, we have an overhead view, a street view, and a map view of the property. All right. And on page, we have some permits. Excuse me.
Bless you.
Thank you. We have some permits. One is an older permit, but on page 13, it's still a little older, but it shows that in 2015, there was $3,675,578 of declared construction value put in, where Manitoba Housing did do interior and exterior alterations and did upgrade the mechanical of the property to keep this a workable building. Thank you.
Thank you, Ms. Martins. Mr. Slaughter, questions?
Just one. So, Ms. Martins, I assume this has a lower capitalization rate than the others. Is that adjustment because of the permit that you mentioned?
I don't have all the notes in front of me. I'm not sure when the adjustments were made to have that carry forward for the lower cap rate.
That's fine. Thank you.
Thank you very much. Ms. Werhan, questions?
My question was answered. Thank you.
Thank you. Ms. Anderson?
Apparently, we were all on the same page. That was my question as well. Did it
Thank you.
change the effective age? No, it did not. So
No.
Interesting. That's it, Madam Chair. Thank you.
Thank you very much. Mr. Slaughter, your presentation, please.
Madam Chair. So page 7 again has photographs of the property. It's very similar again. It is treated separately than 388 and 400, but it's right across the street. Very similar, looks the same, no air conditioning, bare bones, etc. Typically, what I try and do is if I can't physically inspect a property, I like to speak to the client and make sure that I understand some basic facts about the building. Is there anything, that I should be aware of, or what's the average unit size, et cetera. Sometimes one of the arguments we make in functional obsolescence is if the unit sizes are smaller than market. That's not the case here. But one that I didn't catch until the city's evidence was that permit. And that shocked me. And that's a massive permit. So we actually purchased the permits from the city of Winnipeg, and I went to my records and I went back and I see it right here. The item states Manitoba Housing interior and exterior alterations to an existing apartment building. Interior work includes new bulkheads for mechanical and electrical work. Exterior work includes windows and doors with existing openings, repairs to existing masonry, and new balcony railings and wearing surfaces. So I read that and I look at the pictures and it looks the same as the others. And I look at the permit price again and I can't believe the size. But I don't have any information on that. I don't know if that was applied to various properties and not allocated properly, or if that's actually the amount spent. So long story short, Madam Chair, I'm making an adjustment to my valuation right now. And that adjustment, the reason I asked Ms. Martins about their cap rate, because it's 20 basis points less than the other, what appear to be identical properties. And if it was because of the work that appears to have gone into the property, I'd agree with that. I would agree with that adjustment. So I would like to adjust my capitalization rate on this property from the 6 that I'm applying typically, which I think is well supported, to 5.75. Again, that's not based on any qualitative science or quantitative science. That's just an adjustment, but it's pretty close, a little greater than, but close to what the city appears to have done. And so if I take the NOI as agreed upon, and I apply 5.75% of the cap rate instead of 6. Our revised value, Madam Chair, is $2,659,000. And that is what I'd like the board to consider. And that concludes our presentation.
Thank you very much, Mr. Slaughter. Ms. Martins, questions?
No, thank you very much.
Thank you. Ms. Anderson?
Just doing some math, but no questions. Thank you.
Thank you. Ms. Werhan?
None, thank you.
Thank you very much. So, Mr. Slaughter, your adjustment is on the basis of this permit, and obviously work has gone into this particular property, which you believe has improved its condition. Is that it?
That's my opinion based on the information before me. So yes.
And you also discussed with the property owner, manager?
I didn't know about this permit though, so I didn't ask specifically, but I was asking questions to make sure that there was nothing significantly inferior or superior to the properties, and nothing was disclosed. That's why I read that description and I look at that amount and I think that's huge, but obviously work has occurred in the property. So that's why I'm making the adjustment.
And this was from 2015.
It's old. Yeah. It's almost a decade ago.
Yeah. Okay, I have no additional questions. Ms. Martins, summation?
No, thank you.
Thank you. Mr. Slaughter?
Summation. Thank you.
Thank you. Okay, that will conclude item number 8. We have now heard all items on our agenda, and this hearing is now adjourned. Thank you, Ms. Martins and Mr. Slaughter, for your presentations.
Thank you.
Take care.